Welcome back. If you're looking at your portfolio or watching U.S. mortgage rates tick up and wondering, why is this happening when the Fed is talking about cuts? The answer might not be in Washington. It's in Tokyo. Today we're breaking down the massive, invisible engine of the global bond market, the yen carry trade, and why Japan's recent rate hikes are sending shockwaves through U.S. treasuries. Sarah, let's start with the basics. For decades, Japan has been the world's cheapest place to borrow money. How did that create this massive link to U.S. bonds?
Great to be here, Alex. It's called the carry trade. Imagine you can borrow money for free, literally 0% interest, in Japan. You take that money, convert it to US dollars, and buy a safe US Treasury bond paying 4% or 5%. You are essentially pocketing that spread for free. Institutional investors, hedge funds, and banks have done this with trillions of dollars for years. It created a massive artificial demand for US debt.
Okay, so Wall Street has been addicted to cheap Japanese money. But now the Bank of Japan, BOJ, is finally changing the rules. What is happening right now in December 2025?
The BOJ has pivoted. After years of negative or zero rates, they are hiking rates to combat their own domestic inflation. We're seeing rates move towards 0.75% and possibly higher. At the same time, the U.S. Federal Reserve is cutting rates. This is the critical moment. The spread is narrowing. The free lunch is getting expensive. If you borrowed in yen, you now have to pay more interest on that loan. And if the yen strengthens against the dollar, your principal debt gets bigger in dollar terms. The math stops working.
And when the math stops working, what do those investors do?
They unwind. They have to sell the U.S. asset to pay back the yen loan. That means selling U.S. treasuries. Remember, Japan is the largest foreign holder of U.S. government debt, holding over $1 trillion. If they stop buying or worse, start selling, the price of U.S. bonds falls.
And when bond prices fall,
yields rise. Exactly. This is why we are seeing upward pressure on U.S. yields, even as the U.S. economy slows. It's a supply and demand issue. We are losing one of our biggest, most consistent buyers just as the U.S. government is issuing record amounts of debt.
Let's bring this home to the viewer. Why does a guy in Ohio care if a Japanese pension fund sells a bond?
Because U.S. Treasury yields are the benchmark for everything else. Your 30-year fixed mortgage rate? It's directly tied to the 10-year Treasury yield. Your car loan? Your credit card APR? They all track these yields. If Japan's exit pushes U.S. yields up by even 0.5%, that translates to higher borrowing costs for American consumers and businesses, regardless of what the Federal Reserve does with the short-term Fed funds rate. It effectively tightens financial conditions in the U.S., acting like a stealth rate hike.
Is this a crash scenario, or just a correction?
It creates volatility. We saw a preview of this in mid-2024 and again recently. When the yen spikes, algorithms sell U.S. tech stocks and bonds instantly. It's not necessarily a crash, but it removes a massive liquidity cushion that U.S. markets have enjoyed for a decade. The volatility suppression machine that was the Bank of Japan is turning off.
Final thoughts, Sarah. What should investors watch in the coming weeks?
Watch the US dollar to Japanese yen exchange rate and the 10-year JGB, Japanese government bond yield. If the Japanese 10-year yield breaks above 2%, watch for a sharp spike in US Treasury yields. The tether between Tokyo and New York is tighter than ever.
Fascinating stuff. As always, the global economy is more connected than it seems. Thanks, Sarah. If you would like to learn more about these types of topics explained simply, please subscribe and visit my channel for more.